Welcome back, everyone. Let me start with a question that every business leader faces. Why do customers make the choices they do? Why does someone choose Starbucks over Dunkin' Donuts, even when Dunkin' costs less? Why do consumers buy extended warranties they'll probably never use? And why do smart, educated people sometimes make purchasing decisions that seem completely irrational? Answers lie in understanding consumer behavior through an economic lens. This session builds directly on the optimization and decision-making principles we covered in video 1. But instead of focusing on firm behavior, we're diving into the economic psychology of consumer choice. You'll discover that consumers, like businesses, face optimization problems. They're trying to maximize their satisfaction subject to budget constraints and limited information. Understanding consumer behavior isn't just academic theory, it's the foundation of successful business strategy. Companies like Amazon, Apple, Netflix have all built multi-billion-dollar businesses by deeply understanding how consumers think, choose, and behave. By the end of today's session, you'll have the analytical tools to understand your consumers' decision-making processes and design strategies that align with how people actually behave, not just how economic theory says they should behave. As we go through today's content, I want you to think about your own recent purchasing decisions. Can you explain them using rational choice theory? Or do behavioral factors better explain your choices? Here are the learning objectives for this chapter. At the heart of economics is a simple truth. People want more than they can have. From household budgets to national resource allocation, scarcity forces choice. Today's consumers must decide between buying a new phone or saving for retirement, just like businesses choose between investing in marketing or expanding operations. Our job as managers is to help guide these choices for our firms and for our customers through data and strategy. In this slide, we explore the concept of economic choice, which is a fundamental aspect of decision-making in economics. Economic choice involves prioritizing wants and making decisions based on the constraints of limited resources and imperfect information. Individuals have multiple wants and must assign priorities to these wants to make decisions. The process of prioritizing helps individuals choose their most preferred option among the available alternatives. But they have constraints. Limited resources is one of them. Resources such as time, money, materials are finite, and that limits the options available to individuals. Another constraint is costly and imperfect information. Information about the available options and their potential outcomes is often incomplete or costly to obtain, and that affects decision making. Individuals learn from their past decisions and mistakes, and that helps them make better choices in the future. This learning process is essential for improving decision-making over time. Marginal analysis is the decision-making powerhouse of economics. Imagine you run a bakery and you're deciding whether to bake 100 or 110 cupcakes. If the profit from 10 more cupcakes exceeds the added cost, you go for it. It's that simple, but also that powerful. This method applies to everything from hiring decisions to investment strategy. Great managers think at the margin, constantly asking, is the next step worth it? Sunk costs, which are costs that have already been incurred and cannot be recovered. Sunk costs are irrelevant to future decision making because they do not change or regardless of the outcome of the decision. I like to think of sunk cost as the classic trap. We all fall for it, whether it's staying in a bad movie because we paid for the ticket or clinging to a failed marketing campaign because of previous decisions. Here's a real-life example. If Mary pays $5,000 for a year at the tennis club membership, the money spent is a sunk cost. Whether or not she goes to the club and how frequently she uses it is irrelevant to the decision because the money's already been spent. Understanding sunk costs helps individuals and firms avoid the sunk cost fallacy, where they continue investing in a bad decision based on irrecoverable cost rather than the potential future benefits and costs. By recognizing the irrelevance of sunk costs, we can make more rational and informed decisions. Opportunity cost is what you give up when you choose one path over another. Let's say you choose to pursue your MBA full-time. The tuition is an explicit cost. But what about the salary you're not earning? That's your opportunity cost. As leaders, understanding trade-offs help us make smarter choices and gives us empathy for those facing hard decisions. Explicit costs are things you see on a bill. They are direct dollar expenditures that are easily identifiable and measurable. Examples include wages, rent, and materials. Implicit costs reflect opportunity costs that are not direct dollar expenditures, but still represent the value of those foregone alternatives. Implicit costs are just as real, but often overlooked, like the time a business owner spends working for free, or the rent foregone by using your own property. One of your goals in this course is to develop the ability to spot these hidden costs in any decision-making scenario. People are incredibly creative in maximizing their utility, often in ways we don't expect. Think about how businesses find tax loopholes, or how employees gain performance metrics. It's not about dishonesty, it's about responding to the incentive structure. Our challenges as leaders is to anticipate and shape these behaviors with thoughtful design. Now, we use graphical tools like indifference curves and budget constraints as visual aids, and they help us understand choices. They map out preferences and constraints in a way that might reveal different insights. For example, how does a price change shift our choices? Some examples of graphical tools, I mentioned indifference curves. Those represent the combination of goods that provide the same level of utility. Another example would be budget lines. These represent the combinations of goods that a consumer can afford given their income and the prices of the goods. And the third is the production possibilities frontier. This represents the maximum combinations of goods that can be produced given available resources and technology. Each of these tools allows us to model decisions in a structured and powerful way. Goods are things that people value, including standard products like food, clothing, services, and less tangible emotions such as love of family and charity. Utility is a fancy word for satisfaction. Whether it's food, fashion, or fellowship, people want what makes them happy. In the real world, utility might be tied to status, comfort, or even faith. This perspective helps us predict consumer choices and design offerings that truly meet consumers' needs. Utility maximization means choosing the best combination of goods given budget constraints. And so we use indifference curves and budget lines, and we can see where these choices happen. This is especially useful in product design and pricing strategies. Knowing where your customer's sweet spot is can be a game changer. We can show utility function with indifference curves and budget constraints. Indifference curves help us visualize trade-offs. For example, a consumer may be equally happy with 3 sodas and 2 sandwiches, or 2 sodas and 3 sandwiches. As managers, these tools help us model consumer preferences when making marketing or bundling decisions. Some characteristics of indifference curves are that they have negative slopes, and that indicates a trade-off between food and clothing. Indifference curves can be plotted on a graph to show the combinations of 2 goods that provide the same level of utility. For example, this illustration here. The budget constraint reflects reality. You can't buy everything. It's the line between wants and affordability. As managers, understanding consumer constraints helps in product pricing, tiered offerings, and promotions that expand the budget line or create perceived value. Consumer choice is about finding the best combination of goods within constraints. The sweet spot? Where the budget line just touches the highest indifference curve, max satisfaction with available resources. This model helps firms design offerings that appeal to customers' real preferences. When prices change, choices shift. Think about gas prices. When they spike, people carpool more or take public transport. Price changes alter the slope of the budget line, and savvy businesses anticipate this behavior to stay ahead of demand curves. The opportunities refer to the different courses of action or choices that individuals or firms can take to achieve those goals. And the constraints are the limitations or the restrictions that impact the feasibility of these opportunities. Now, this really makes logical sense when you look at it. An increase in income shifts the budget constraint outward, allowing consumers to afford more of both goods. A decrease in income shifts the budget constraint inward, reducing the combination of that good that a consumer can afford. Let's take a real-world example here to illustrate the impact of income changes on consumer choices and budget constraint. Imagine a family with an income of $3,000. They allocate their income to 2 main categories, groceries and entertainment. Initially, they spend $1,500 on groceries and $1,500 on entertainment. This allocation represents their budget constraint. Now, suppose the family's income increases to $4,000 a month. With the additional income, they can afford to spend more on both groceries and entertainment. Their new budget constraint shifts outward, allowing them to allocate $2,000 to groceries and $2,000 to entertainment, or any other combination that fits within their new budget. Conversely, if the family's income decreases to $2,000 per month, their budget constraint shifts inward. They now have to make tougher choices and may need to allocate $1,000 to groceries and $1,000 to entertainment, or find other ways to adjust their spending to fit within their reduced budget. Here's another example. Imagine you're at a carnival and you have a budget of $20 to spend on 2 of your favorite activities, riding the Ferris wheel and eating cotton candy, my personal favorite. Initially, the Ferris wheel ride costs $5 and a bag of cotton candy costs $2. With your $20, you can afford to ride the Ferris wheel 4 times or buy 10 bags of cotton candy or any combination in between. Now let's say that the carnival announces a special discount. The price of the Ferris wheel ride drops to $3. Suddenly your budget constraint shifts and you can afford more rides on the Ferris wheel. You might decide to ride the Ferris wheel 5 times and still have enough money left to buy 5 bags of cotton candy. This change in price allows you to enjoy more of both activities, maximizing your fun at the carnival. On the other hand, if the Ferris wheel ride increases to $7, your budget constraint tightens. You might only be able to afford 2 rides on the Ferris wheel and still have enough money left for the 6 bags of yummy cotton candy. This price change increase forces you to make tougher choices and prioritize your spending to get the most enjoyment out of your limited budget. This example, silly as it is, shows how changes in prices affect your budget constraint and the choices you make to maximize your utility, or in this case, your fun at the carnival. The optimal choice is the point where the budget constraint is tangent to the highest possible indifference curve. And you can see that here. This point represents the combination of goods that maximizes the consumer's utility given their income and prices of the goods. Points on a higher indifference curves are preferred, but they're infeasible, while points lower on the indifference curves are feasible, but less preferred. Changes in the prices of goods also affects the slope of the budget constraint and consequently the optimal choice of goods. A decrease in the price of a good makes it relatively cheaper, leading consumers to substitute towards that good and away from other goods. An increase of a price of a good makes it relatively more expensive, leading consumers to substitute away from the good towards other goods. The new optimal choice can be represented graphically as the point of tangency between the new budget constraint and an indifference curve. Managers must tread carefully. Getting incentives right is a balancing act. Incentives can spark innovation or they can spark scandal. Whether you're designing a compensation package or setting KPIs, always consider the ripple effects. In this slide, we'll discuss the challenges and strategies for motivating honesty among bankers at Wells Fargo. The bank paid its bankers bonuses based on meeting targets for the number of new accounts and other products sold to customers. However, if a banker rated a product poorly, consumers might take their business elsewhere, resulting in a smaller bonus for the banker. This creates a trade-off between integrity and money, highlighting the ethical dilemmas faced by bankers in the pursuit of financial incentives. There are multiple models of human behavior. Some assume people only care about money. Others say happiness or citizenship matters. The truth is, people are complex. As Christian managers, we must consider the whole person. Spiritual, emotional, and social needs matter alongside the financial ones. This slide illustrates the constraints and opportunities available to an analyst at Wells Fargo. The constraint shows the maximum amounts of money and integrity that are possible for a banker given the bonus plan and conditions at Wells Fargo. Really, this slide emphasizes the trade-offs between financial incentives and ethical behavior and how these trade-offs impact the decisions made by analysts. Which models fit best? Depends on the context. There's really no one size fits all, but the economic framework is a great starting point. Change incentives, change behavior. The key is using wisdom and discernment to match the model with the situation when analyzing these type of scenarios. Behavioral economics challenges the idea that people are fully rational. We procrastinate, we overreact, and we misjudge risk. Think of how people buy extended warranties that they don't need. As leaders, behavioral insights help us design better policies, interfaces, and experiences. I want to talk more about the Wells Fargo debacle. On this slide, we explore optimal choices of a retail banker at Wells Fargo under two different compensation plans. Case 1 reflects the original compensation plan. This one includes a high bonus based on the number of new accounts and products, and the constraint is relatively steep. In case 2, the firm reduces the emphasis on accounts and sales in determining bonuses. The slope of the constraint is flatter. The result is that the individual chooses a higher level of integrity in case 2 than in case 1. By comparing the outcomes of these two plans, we can understand how changes in compensation structures influence the behavior and decision-making of bankers. Every decision involves risk. Should we invest in a new market, hire a new vendor, launch a new product? Understanding expected value and risk preference helps us make wise choices, especially when the outcomes are not guaranteed. Managers must be careful in setting these incentives, as improper incentives can lead to perverse behavior, kind of like what we saw in the Wells Fargo case. There are alternative models of behavior, and here are a few of these models. The only money matters, happy is productive, good citizen, productive product of the environment, economic model. And each of these can be used in various ways depending on the scenario. Which model should the manager use? No single behavior model is likely to be used in all contexts. Managers are often interested in fostering changes in behavior, and the economic framework provides guidance on how to alter behavior. Desired behavior can be encouraged by changing the feasible opportunities facing the decision maker. Behavior economics extends the standard economic framework to account for irrational behavior. Traditional models assume individuals are rational, but behavioral economics incorporates more realistic assumptions about human behavior. Since nothing is guaranteed, we make decisions based on the expected value of the outcome. The amount of risk is measured by the standard deviation of the value of the outcomes. People choose a balance between expected value, their return, and risk. Here we examine indifference curves for expected value and standard deviation. A risk-averse individual prefers higher expected value but lower standard deviation, which is a measure of risk. This slide helps in understanding how individuals make decisions in uncertainty. I want to just do a very quick review here of the appendix of this chapter. I do encourage you to read through that in your textbook, but I just want to touch on a few highlights in wrapping up this lecture. In this slide, we explore Tom's utility as a function of food, with clothing purchases held at a constant 10. The marginal utility of food is 10, which is the slope of the utility line. This slide helps in understanding the concept of marginal utility and how it influences consumer choices. This slide presents an indifference curve that reflects 100 units of utility. It helps in understanding the concepts of indifference curves and trade-offs between different goods. If you need more help in these slides that I'm showing you here, Chapter 2 does a great job of explaining these concepts in more detail. In this slide, we discuss the income and substitution effects. With budget line B1 and indifference curve I1, Tom chooses T1. In other words, when food becomes more expensive, Tom moves to T2. This includes the substitution effect and an income effect. This slide explores the income effects in the supply of labor. Ralph Cramden divides 100 hours per week between work and leisure. When his wage rate rises, he works fewer hours because the income effect is larger than the substitution effect. This slide helps us understand how changes in wages affect the supply of labor through income effects. And lastly, in this slide, this is an illustration of the convexity of indifference curves. Convexity implies that as a consumer substitutes one good for another, the amount of the good being given up decreases. This slide helps us understand the principle of diminishing marginal rate of substitution and its implications for consumer choice.